Institutional investors are repricing climate exposure. Now, something shifted in the capital markets over the past 18 months, and it did not make headlines the way a rate hike would. Quietly, systematically, institutional investors have begun embedding climate exposure into their pricing models, not as a values exercise, but as a straightforward risk calculation. The companies that recognize what is happening now will have options. Those that do not will discover the new terms when they go back to market. This is not about ESG sentiment. It is about how large asset managers and insurers are measuring the probability that your balance sheet is carrying risks that your current disclosures do not fully capture. Stranded assets, regulatory penalties, supply chain interruption tied to physical climate events, or the cost of retrofitting infrastructure that was never designed for a decarbonizing grid. When those risks are visible, they attract a premium. When they are invisible, the premium is still there. It's just baked silently into the terms. Where the repricing is happening, the shift is most visible in three places: green bond markets, private infrastructure lending, and public equity pricing for capital-intensive industrials. In green bond issuance, the spread compression that issuers enjoyed in 2021 and 2022 has become more selective. Proceeds verification is tighter, post-issuance reporting requirements are more demanding, and investors are asking harder questions about what qualifies. In private credit and infrastructure lending, particularly for energy transition assets, lenders are extending financing, but the terms increasingly reflect the regulatory and permitting risk profile of the underlying project. A solar plus storage development in a state with active interconnection reform looks different on a term sheet than one in a grid with a 3-year queue backlog. Lenders know the difference now in ways they did not 4 years ago. In public markets, the premium assigned to companies with credible, auditable climate transition plans has narrowed, but the discount applied to companies perceived as having unpriced exposure has grown. Analysts are treating unresolved Scope 1 and Scope 3 gaps not as disclosure failures, but as evidence of management blind spots. What this means for capital planning. CFOs and treasurers need to run a direct question through their capital plans for the next 2 years. At what point does our climate disclosure quality affect our refinancing terms? For most companies in energy-intensive sectors, the answer is sooner than the financial planning cycle currently assumes. The practical implication is not that every company needs a net zero pledge. It is that your investors and lenders are building models of your exposure, and the less information you give them, the more conservative those models will be. A gap in disclosure is not neutral. It is read as risk. Boards that treat climate reporting as a compliance function rather than a capital markets community function are already behind. The 6 to 18-month window. The companies best positioned heading into 2027 are those that act in the next 2 quarters, improving disclosure quality, stress testing capital plans against a range of transition scenarios, and briefing investor relations teams to handle climate-specific questions with the same fluency as earnings guidance. The investors who are repricing now are the same ones who will be at the table for the next refinancing cycle. What they see between now and then will shape the terms they offer. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.